For nearly 80 years, the global financial system has rested on a single, dominant pillar, the United States dollar. It is the currency of trade, the currency of debt, and the currency of power. Since the end of the gold standard in 1971, the dollar's value has been backed not by gold, but by the faith and credit of the United States government itself. But in the darker, quieter corners of the digital world, a different kind of standard has emerged, one not issued by central banks or politicians, but enforced by mathematics and code. For more than a decade, Washington publicly dismissed Bitcoin as a tool for criminals, a speculative bubble, or a passing technological fad. Officials mocked it. Regulators fought it. And yet, beneath the surface, something far more interesting was happening. Without press conferences or public celebrations, the United States government began acquiring Bitcoin. Not through policy, but through law enforcement. The story of America's Bitcoin holdings does not begin in the Treasury Department. It begins in the evidence rooms of the Department of Justice. Over the last decade, federal agencies have carried out some of the largest digital asset seizures in history. From the shutdown of the Silk Road marketplace to the recovery of funds stolen in the Bitfinex hack, billions of dollars worth of Bitcoin passed into government custody. These seizures are not secret. They are documented in court filings, forfeiture records, and publicly traceable blockchain data. According to estimates from multiple blockchain analysis firms and public DOJ disclosures, wallets associated with U.S. government seizures have, at times, controlled well over 200,000 Bitcoin. For years, the procedure was straightforward: seize the assets, auction them to the public, convert them into dollars, and move on. Bitcoin was treated as contraband, never as a strategic asset. Then, something changed. Around the early 2020s, public Bitcoin auctions became less frequent. Some wallets associated with federal seizures stopped moving altogether. Analysts watching the blockchain noticed a pattern: large balances sitting untouched in long-term cold storage. This did not confirm a new policy, but it raised questions. At the same time, the political climate in Washington began to shift. During a heated election cycle, an idea once considered fringe started appearing in mainstream policy discussions: the concept of a strategic Bitcoin reserve. The proposal was bold, but hypothetical. Instead of immediately selling seized Bitcoin, the United States could hold it, treating it more like gold or oil than criminal proceeds. Supporters of the idea argued that in an increasingly digital world, strategic assets would no longer be purely physical. Some went further, suggesting that holding Bitcoin could complement, not replace, the dollar's dominance by anchoring it to the hardest digital asset ever created. Importantly, this was not official policy. It was a debate. A signal. But markets tend to react to signals long before laws are passed. The first reactions appeared quietly in derivatives and futures markets. Then, momentum built. Bitcoin's price began to move independently of traditional stock market trends that had previously defined crypto winters. This did not look like retail speculation. To many analysts, it resembled large-scale, long-term accumulation, the kind associated with institutions or sovereign entities. The mere possibility that the world's dominant superpower might one day recognize Bitcoin as a reserve asset sent ripples through central banks from Frankfurt to Beijing. If the United States holds Bitcoin at scale, does that change Bitcoin's role in the global system? And if it does, what happens to countries that hold none at all? The geopolitical implications were immediate. Smaller nations such as El Salvador, once mocked for adopting Bitcoin, were suddenly re-examined, not as reckless gamblers, but as early movers. Even traditional economists, long skeptical of crypto, struggle to explain a growing paradox: the idea that the dollar's strength might be reinforced, not weakened, by exposure to a competing asset. Legislative proposals like the Digital Assets Strategic Reserve Act were not guarantees of change, but they were signals. Signals that the financial architecture of the 21st century was no longer theoretical. It was being negotiated in real time. As price charts pushed into new territory and long-dormant narratives collapsed, one truth became clear: the era of magic internet money was over. What replaced it was something far more serious: a state-level digital arms race. The United States made its position clear. It would not ban the future. It would prepare for it. The vaults of power are no longer defined solely by gold bars and oil reserves. Increasingly, they are defined by cryptographic keys and immutable ledgers. And as the world watches this balance shift, one question remains unanswered. Is this the beginning of the end for the dollar's hegemony, or the foundation of its next digital evolution? The answer, as always, is being written block by block, indifferent to politics, elections, and who occupies the Oval Office.